Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a look at the disclaimer, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that either decrease or increase in importance over time. We will try to highlight some of these key themes, some of these narratives, some of these stories, which we think, of course, are driving markets at the moment. And whilst I just let you have a look at those disclaimers, which are on the screen now, yeah, our goal is as well to break down all the market jargon and complexities that we all read about. So if you do have any questions, please do ask them along the way, and I'll hope to answer them as soon as possible, or at least after the webinar finishes. This week, we will look at the key data out of the UK, review some of that, and of course, US CPI from last week. We'll then kick off actually with a look at stock markets and the earnings season, as well as how markets are generally shaping up at the moment. And then after all of that, we'll wrap up hopefully with euro dollar and looking at the important PMI data, which is out on Friday. Okay, markets currently at the moment kind of in a holding pattern really. It's quite a light US calendar. Volatilities really are falling, especially from those mid-March very high volatility measures. They are all falling now. Interesting that the VIX, so that's the volatility index, which tracks basically options prices on the S&P 500 out of 30 days or for 30 days, the next 30 days, that has fallen now. You can see this chart here actually, which shows the VIX. So that's kind of the Wall Street fear gauge is what it's known as, but that has fallen to around 17 there. The long-term average generally recognized around 20, so very quiet volatility measures in stocks and also in some of the other key asset classes. So interesting to note. Some can sometimes be, of course, a contrarian indicator. So quiet volatility leads to obviously a pickup in vols. Focus, of course, in stocks has turned to the easing season, earnings season, as it unfolds with roughly 26% of the S&P 500 companies that will have reported by the end of this week, and around 60% by the end of next. S&P 500 price action kind of remains bottled up near that 4,200 resistance level. We'll look at that shortly, and it's this idea around a small cluster of big, large cap, mega cap tech stocks really that have driven most of the gains for this year. A host of regional US banks, both large and small, will report their earnings in the coming couple of days, and that should really help the market gauge this status of the ongoing stress on banks as depositors, of course, shift from those smaller regional US banks to the bigger ones, and they also seek, of course, higher yields. Along with those corporate earnings, we get Tesla results out after the bell tonight. Of course, that stock has fallen over 40% over the last 12 months and then rebounded more than 3/4 of its value this year. A drop in profits is expected as prices of the vehicles were cut. So a key focus will be on margins. That's for Tesla's results, which are after the bell, as I said. For FX markets, attention will be on a lot of Fed and ECB speakers who will be able to give their final guidance really in the run-up to their early May central bank meetings. As I said, we get Friday's PMI data. That's probably the most high-profile Eurozone data. So we'll look at that towards the end of the webinar. And then UK markets, as I mentioned, have been dealing with this extensive data update. Lots of data this week, middle of the month. So we always get this sort of deluge of labour market data, inflation data today we had, and then retail sales on Friday. That's really around what the Bank of England as well does at its early May meeting. That is the week after actually the Fed and the ECB, which kick off May. As I said, for FX majors then, the key focus really recently has been on those big levels in euro at 110, sterling 125, and now dollar yen actually testing and breaking or touching even 135. The dollar, though, has found some support this week as bond yields have put higher. And if we just check out the 2-year yield, we don't look at these charts a great deal, but we think this is an important chart really because, sorry, just bear with me 1 second, just because, of course, this is what is underpinning, we think, support for the dollar, especially this week. And you can just see on this chart, you can see this massive volatility in markets around the banking crises, of course. You can see that collapse when 2-year yields, 2-year treasury yields, these are of course, that up above 5% and then rapidly fell below 4%, and the low sort of towards the end of March, end of the banking crisis, really, that date, the 24th, close to 3.5%. So an absolutely massive move in bond markets. Can't be understated, really. Historic volatility, sort of for a couple of weeks from mid-March onwards. But you can see now yields really have picked up, and we focus on 2-year yields because they map the Fed funds futures rate very closely, which is obviously the main interest rate for the US. And you can just see here, we sort of toyed with this black line, which is a 200-day moving average. That's now at 4.08. And we've just put above there over the last few days a consecutive run of gains in yields. So that means bond prices are going down, yields are going up, and that has shown or given, as I say, some support to the dollar. If you just look back, actually, we can see prices had sort of stayed above 4% for quite some time, going back to sort of September when we broke above that, and then we've stayed sort of being supported by that 4% level very well, actually, across quite a few months. Back end of last year up to the 5% and then down to 3.5%, and now we're back above 4%. So this potentially is worth looking at because of it helping the dollar. Of course, if the yields if this rally doesn't continue, then the dollar, of course, may have difficulty staging a sustained comeback. If they do continue, then potentially the dollar can move slightly higher. These blue and grey lines here, just to put long-term moving averages, the 50-day moving average and the 100-day. So we might come into some resistance there. You see just around 4.33%. That's the 2-year US Treasury yield. Otherwise, coming back to stocks then, as I said, we're in the thick of course, corporate earnings. We've had some of the countries, the US biggest lenders, JP Morgan Chase last week, that led the gainers up 7.6% after it released its results. It beat estimates with Q1 profits rising 52%. We also had Wells Fargo, Citibank exceeding analyst expectations last week. And then we've had Goldman Sachs a bit more mixed. We have Morgan Stanley's results out in an hour or so, I believe, as well as US Bank Corps. So that's one of the bigger US regional banks, which will be important, as we've mentioned, because of this issue around taking their money out of these smaller regional banks and ultimately putting in some of these too big to fail banks like Chase, for example. Overall, though, just getting away from banks, if you like, and some of those sort of well-known names like Tesla, Netflix, of course, reported overnight, but generally overall Q1 earnings should reflect really quite solid economic growth, whilst those big cuts that we have seen to estimates by FactSet, Bloomberg sort of looking at 8% fall in EPS. Those big cuts to estimates really have left room for beats, one might say. Too pessimistic, those cuts, therefore more chance of getting a beat in earnings. Certainly if the all-important financials do hold up, then that sort of deep earnings recession in this financial year, which was seen a few weeks ago, of course, during the banking crisis, then that is seen as unlikely. Performance-wise, the S&P, well, it added last week, but it's mixed so far this week. Nasdaq gained 3% across the last 5 sessions last week, but it is in the red this week, and especially with futures showing a quite a negative open. We can see Nasdaq futures down 0.88% here, S&P 500, the benchmark, down 0.61% or so. That's the futures, so that would turn markets lower on the week. Just on the technicals then, if we just look at some of those, first of all, this is the weekly chart. So you can see really after doji here a couple of weeks ago, that's that green candle, very thin green candle there, where prices close in the middle of the high and the middle of the low, open and close really at the same level, very similar level. That's a doji, kind of signals some sort of pause, indecision between buyers and sellers, of course. We have pushed up now above that long-term trend line, which had acted a resistance. You can see in January, February, couldn't quite beat that trend line, so reinforce that resistance. But then last week, I'll just blow this up slightly, you can see we closed, pushed above and closed above it. So quite notable for us. And then this week, actually, we need to hold above that sort of trend line resistance now support, which comes in probably around 4085. So that should act, we think, as near-term support. You also have some Fibonacci levels, 4155. It's where we closed last night, actually. So that is the halfway point of the 2022 decline. So that's an interesting level. But a lot of watchers, a lot of punters, if you like, are looking at the January high 4195, 4200 or so, tallies with the 100-day moving average, that grey line, sorry, the 100-week moving average at 4203. So that is potential resistance. Sorry about that. And if we do roll over, then yes, we have sort of 4,080 or so as initial support, but then rolling back into sort of 4,000 potential. But volatility is very is much reduced and very quiet, actually. So interesting to see where we go going forward. And you can see just on the daily, that 4195 level, key for the upside, key for bulls, but we're still in this sort of channel, really, higher highs, higher lows, and unless we sort of tap lower towards, well, at least this week's highs, probably this week's low, sorry, then we might move down towards sort of 4,080 or so. On the Nasdaq, similarly on the weekly, we had that doji candle a couple of weeks ago, but importantly, we stayed above this January high at 12,880. We're kind of tracking sideways. You can see that on the daily, but we're still above that 12,880 level. So potentially then we should break and push. Well, the breakout will be strong. The longer we track sideways, then the bigger range expansion should be. Prices are trending higher, so historically that would mean we break in line with the dominant trend, but certainly 13,204 is the key upside level there. If we don't break that soon, then we're tracking sideways and potentially then we roll over, but 8,080 is key. Otherwise then we're back to sort of 12,000, 12,500 or so. That's the Nasdaq 100. Also, just let's quickly look at the Dow on the weekly. Decent gains. You can see a few consecutive levels, weeks of gains, 4 weeks actually. And we initially kicked off this week quite well as well. The January 2020 top is, well, 4 weeks of gains are in the Dow. We've got the 100-week moving average, which is 33,664. We've broken above that, so that should act as potential support. We've got some fib levels in there, but otherwise, the upside level, key upside level for us still remains that mid-August from last year high at 34,281. You can see it's capped the upside numerous occasions this year, back end of last year. And again, if we pull that out, you can see that big level of resistance. Quite a nice consolidation though for us on the daily. So potentially, if we do break near term 34,082, then obviously that 34,281 level comes into view. Okay, we'll now go to just last week's events. The main event being, of course, the US CPI data. Were always worth, we think, recapping on that just to highlight it, what it means going forward. Of course, US CPI rose 0.1 month on month, below the 0.2 rate expected. Core CPI, that continues to run hot, 0.4% month on month, and that was in line with expectations. But that all means the annual rate of core inflation actually rose to 5.6% from 5.5%, despite that headline number dropping from 6% to 5%. Of course, that was a lot down to energy prices, petrol, gasoline prices falling, of course. It was a 9th straight month of declines at the lowest level in nearly 2 years. But what we want to focus on is this core monthly number, strips out those volatile energy food costs, still at 4%, as we said. That's economists reckon more than double the 0.17% they reckon is needed to be averaged over time to bring the annual rate of inflation of core inflation, that is, back to 2%. That's the Fed's target. So going forward, certainly shelter costs, a lot of focus on those, which have a lagging effect, and they've been a big contributor to sticky core CPI. But they are actually seen falling in the months ahead, according to numerous leading indicators. And we've just got a few charts here just to highlight some of these differences between services, core services CPI, which is still going up, sort of slowing slightly, and then core goods services, which has fallen sharply. So interesting point for the FOMC. And then you've got this shelter, ex-shelter costs, if you like, which we've just highlighted. The red line, well, sorry, the dotted line is the 6-month average. That is now falling quite sharply. The month-on-month line, the red line, still moving higher. But the 6-month, the longer-term trend is now moving down. That's in core CPI ex-shelter. As I say, those shelter costs as well, potentially coming down, leading indicators pointing to that. So really, markets then have nailed on a 25 basis point May Fed funds rate hike. That's on 2nd of May. I think there's now around 87% chance of that happening. And really, it'll be interesting. The combination of higher borrowing costs and tightening of lending conditions will potentially result in, of course, these banking stresses then heightening that risk potentially of a harder economic landing, potentially. But that then does bring the likelihood of inflation returning to that 2% target quicker than was expected before the banking crisis. Remember, the Fed's dual mandate of profitability as well as maximizing employment does give it greater flexibility than most other central banks. And then assuming potentially if inflation does slow rapidly through the second half of the year, then we get unemployment rising as well, and that will be interesting for the Fed potentially in the months ahead. Then, as they change probably the narrative between looking at fighting inflation to more focus on the employment side as unemployment picks up. That's probably quite a few months away, firstly, and the focus still remains on inflation, of course. I've mentioned the speakers, a lot of speakers out this week, reinforcing the fact of this that they see the 25 basis point rate hike. That was in the March dot plot, of course. So sort of no great movement there potentially expected for the Fed funds rate. Although we must highlight this obviously difference between the market, which is still pricing in Fed rate cuts towards the end of the year, whereas the Fed speakers and as well the dot plot don't see any cuts at all for this year. We did get other data, US data, as the calendar's thin this week, just highlighting some of the last week's important data. We had bigger initial jobless claims. We had mixed US retail sales, really. The headline fell, and the core retail sales figures were also weak. Although the retail control group, which is an input into the sort of consumer spending section of GDP, that also declined, but it came in better than the Bloomberg consensus estimate. Okay, let's just look at the DXY. So that's the dollar index, widely followed index, which maps the dollar against 6 of its biggest trading partners. Euro has by far the biggest weighting, of course, over 57% or so, I think. So just looking at the DXY chart that you can see here, we've still got this descending channel here, and we're sort of tapping the upper end of it now. So an important really move, whether we can break out decisively of this bear channel. That's the series of descending lower lows, lower highs, been quite neat since that March high before the banking crisis. And now, as I've showed you, the 2-year yields, those are pushing up, and that's giving support to the dollar. Potentially then, if it does break out of this descending bear channel, then the DXY, we'd probably look towards 102.80 as a key level if we can really stop this decline and move potentially a bit higher towards 103 and above. That 102.99, this dotted line, is actually the pandemic spike high from 2020, so we've kept it in there as a marker, and then the other dotted line is a long-term spike high from late 2017, early 2018. So just a few levels on the upside, 103 potentially, and then we get those long-term moving averages, well, the 50-day moving average at 103.36. Otherwise, we roll over then, of course, 182, that is now very strong support after last week's failure to move and close down below there, and in fact bounced quite nicely. Also last week, we just want to highlight the Bank of Canada meeting. They put back on rate cuts, though that was certainly not enough really for markets. They left rates unchanged at 4.5% as expected. So really the conditional pause at 4.5%, which they mentioned before in the previous meeting, that was extended. Policymakers, they sounded more optimistic that a hard landing would be averted, and Governor Macklem actually took the opportunity to underline that policymakers had discussed the likelihood that policy would have to stay higher for longer to curb inflation. And this is why we're kind of going into the Bank of Canada potentially as a precursor for the Fed. Maybe, maybe not, but interesting what they're saying. They also made it that actually even clearer by the governor stating outright the rate cuts implied by market pricing by year end does not look like the most likely scenario for the Bank of Canada, for policymakers there. Clearly, as well, a major goal of the press conference was them to put back on that market pricing for a rate cut by year end. Although, as I said, markets were kind of reluctant to adjust their rate of 4.25% in December. We did get as well CPI data out yesterday, actually out of Canada, which showed the rate slowing to 4.3% in March. That was the slowest pace since 2020, I think, 2021, but still more than double the Bank of Canada's 2% target. Just bear with me. I'm just pulling up the dollar CAD chart now, which you can see, of course. CPI data, the headline fell from 5.2% in February, as I said, to 4.3%. That matched expectations. As a decline in energy prices helped offset that record spike in mortgage costs. The Bank of Canada kind of thinks the headline figure won't hit its target until the end of 2024, so next year. But all in, the data was probably modestly good news, with all core measures that the bank looks at coming down. So on to dollar CAD, of course, on the technicals. You can see it's possible sort of triple top. We probably have to break below that neckline around 133 really, for then a big measured move down lower towards the 130 and below. At the moment, that's stabilizing. You can see I've got some fib levels in here from sort of the July, August lows up to the October last year high. The halfway point of that is 133.52. We've kind of bounced quite a nice level there. Of support really. We bounced off that this week. We're picking up above 134 now. You can see the 200-day moving average, always widely watched level. That's a 134.04, and we've pushed above that with this dollar strength today. Interesting then whether we can then get to sort of 135 or so potentially with this strong support around 133 and then 134. That's in dollar CAD. Okay, moving on to this week's data. And I mentioned always get a strong this mid-month sort of slew of economic data across this week that we've had. We always get that in the middle of the month. And really how that will then direct the Bank of England's meeting on May 11th. Before this week, really, bank officials really largely refused to be drawn either way on what they were going to do. And the most recent, actually, March meeting kept the range of options wide open. So we had yesterday's UK jobs data. That strong employment was strong. Wage growth also surpassed the consensus, 6.6% that was versus 6.2%. Seen before. At the same time, unemployment picked up slightly, 3.7% to 3.8%. Previously, then there has been signs that wage growth may finally have picked, but that really has lost momentum over the winter, and wage growth really picking up. That is very important for the Bank of England. The tightness of the labour market was a key factor as well for actually 7 members of the MPC who voted for a 25 basis point hike in March. That was on the basis that renewed and sustained demand for labour could still reinforce the persistence of high costs in consumer prices. And again, kind of that feeds into today's data, inflation data, well above expectations. Headline month-on-month rose 0.8% against 0.5% expected. The headline grabbing yearly number rose to 10.1% above the 9.1% expected. So really another upside surprise, unwanted upside surprise for the Bank of England. Core as well, so strips out those volatile food and energy costs, which food of course drove that headline figure above 10%. Food prices I think around 17% now inflation. But core inflation strips those out. That held steady at 6.2%. But above 6% expected. PPI was also higher than expected, so that's producer prices, and then certainly then combined with yesterday's strong labour market data really gives the Bank of England little choice in having to hike rates by at least 25 basis points in May. Markets now, I think they put that above a 90% chance of that hike happening, and there's now around 70 basis points or so of total tightening over the next 4 meetings. So in fact, I'd actually drawn this or got this chart actually when there are only 2 more hikes expected, but now after this data, really important data, market's really seeing around 70 basis points of tightening. So that's nearly 3 more 25 basis point hikes, which would potentially take rates up to 5% in the UK. A lot of economists thinking that is a big stretch, and that certainly, well, we were 50-50 going into this week for even a 25 basis point hike. So seeing 3 more on the back of this data will be interesting. Certainly would support sterling. So we will sort of see what happens in a couple of weeks at the MPC, the Bank of England meeting. For sterling itself, well, we do get retail sales, I should say, on Friday, and PMIs. Retail sales, just to touch upon, had a strong run this year. Retail recovery, I think, is being classed at, but a modest pullback is expected in the figures on Friday morning. That said, energy prices are set to dip from the summer, and consumer confidence is off the lows now. So the worst for the retail sector may be behind us. That's what a lot of economists are saying. PMIs, they're expected to show manufacturing still struggling, while services remains above the 50 boom or bust level, which a lot of people look out for. The composite 2 should stick above that level, with the immediate banking crisis troubles easing, so really sort of shoring up confidence. Sterling then going to that, interesting, it's kind of returned to slightly to its old habits over the last few weeks and months or so, really, which means it's tracking stock markets. The 1-month correlation between cable, so sterling, dollar, and the S&P 500 has risen above 80%, and that's really put to the fact that the main driver of the bank has been risk sentiment, global investment mood, really, and that kind of explains why sterling has topped the charts actually for major performance this year. So it does imply if there is a turnaround in equities, then potentially that could be damaging to sterling, although we do then obviously contend with potentially those rate hikes by the Bank of England, then supporting sterling as well. If we just go to cable, then the chart, let me just pull that up. Bear with me 1 second. That's dollar CAD, of course. So if we just go to cable, interesting, really, we did pop up after the CPI figures up to, you can see 124.72. So above that key level we have at 124.47. But that was after the CPI figures, as I say, but we now put back on this really on the dollar strength. Because if you look at other sterling crosses, for example, they're pretty strong, I'd say. You can see these figures here. Against the Aussie up 0.4%, up against the Swiss 0.4%, the yen 0.57%. So sterling still strong, just not against the dollar. Dollar strength is quite evident today. But just looking at cable, then we did pop up to 125.46 last week. Really disappointing. We couldn't close above 125 and above 124.47. So key level for us now, sort of resistance again. If we can't close above it, especially with this strong data, quite interesting on cable. If we do look at, we should look at, say, euro sterling. We've kept in these lines here, so sort of range trading that we have been for the last year or so, just popped above it for a few days before then put back into the range down to the lower part 87.21 we've got it at, and the top side at 88.66. And you can see Monday we tapped that again and then rolled over and are now falling back towards potentially, well, first level of support, which is the grey line there, 100-day moving average at 87.94. If we do move below that, then potentially we're moving down towards 87.50 or so. That's in euro sterling, and you can see then sterling sort of quite strong with these rate hikes being priced in by money markets. Okay, just moving finally on to the eurozone. Just PMI data, always important. So that's survey data, which is a leading indicator for economists really to gauge how the economy is doing and helps with forecasting inflation, GDP figures going forward. So will be interesting, this data, as it's really been providing quite conflicting signals, the survey data in the Eurozone in recent months. We've had the PMIs quite upbeat, whereas the European Commission surveys on sentiment has shown really a more cautious picture of actual growth developments. So the April data should provide, as I said, a sense of direction for the economy, which is battling with, of course, high core inflation, although then experiencing some tailwinds from easing supply chain problems and also energy prices, which are moderating. So expectations for the data to record a further rise in activity, with manufacturing PMI rising to 48.0 from 47.3, whereas services is expected to fall slightly to 54.6 from 55.0. That leaves the composite, so of those two measures, at well, ticking up slightly to 54.0 from 53.7. The previous report, just to remember, that saw the composite reading advance to that 53.7 number from 52, with the jump in the services metric offsetting those declines in manufacturing. It really sort of gave even more fresh conviction, if you like, to the view that the euro area really is clear of that recession, which, if you remember, back end of last year was a real doomsday scenario. Going forward, then the focus will be on how the recent banking woes have affected activity, and there are still expectations of a tightening of credit conditions, which began actually before the issues of last month, potentially weighing on activity as we go through the year slightly. So that's something to bear in mind. As for the ECB, we get a lot of speakers out this week, as we mentioned. We have Chief Economist Philip Lane, then we have a couple of hawks, Knott and Schnabel, as well as then a dove, because that is all coming this week, obviously before then the May 4th meeting, I think, first week in May anyway, for the ECB meeting. Markets pricing in 30 basis point tightening, so above a 25 basis point hike really for that meeting. A total of 80 basis points, just above 80 basis points by October. So that means potentially at least 3 more 25 basis points hikes by October. So ultimately you get one in May, June and July potentially. But it also then sets the bar quite high for a hawkish surprise, and that's essentially ECB members would need to open the door to, say, a 50 basis point hike, which we're not really getting, only from some of the extreme hawks. Also, we're very close to that meeting, as I mentioned, so potentially communications will dial down. Really reinforcing what we've seen, which is that 25 basis point rate increase being nailed on. Euro dollar then, just let's look at that. Technically, euro dollar being driven now by US dollar dynamics then, and risk sentiment as that 25 basis point hikes, well, by the Fed and the ECB nailed on, as I say. We can see, again, similar to sterling, really, we did pop up above 110, got everybody excited, a high of 110.75, but we couldn't close there on the weekly. That you'll just see here. We closed at 109.93, so not above 110 and not above that January year-to-date high at 110.32. So disappointing. We've got a fib level in here, which is the halfway point of the 2021-2022 decline. That's at 109.42. So we're trading right around that level now. Still have a nice uptrend. So potentially, as long as we don't lose probably 109.09, then we would roll back towards 108 potentially. But if we can stay with this bullish momentum, then potentially we'll look to above 110, but 110.32 really strong resistance now on euro dollar. Sorry, that's the chart there, of course. Sorry, I didn't have that on there. I had the previous chart. Yeah, so 110.75, the previous, last week's high couldn't close above there. 110.32 now, key resistance, strong resistance on the upside. If we do lose 109.09, then potentially we roll back down towards 108. Okay, we'll wrap it up there. Hopefully that's been of use to you guys. We've looked at, of course, quite a few majors, and of course stock markets will be really key. The earnings season going forward, of course, for stocks, for risk sentiment. As we've mentioned, Tesla out after the bell tonight. And then we also get Morgan Stanley shortly, as I mentioned, Blackstone tomorrow, big financial group. And then obviously that data out on Friday, UK retail sales and the Eurozone PMIs in focus. Okay, lots to look forward to, and we'll speak to you in a couple of weeks. Take care.